Hello everyone. So in this video, we will be discussing the basic methods for economy studies. So actually there are a lot of methods for the economy studies, but in this video, we will only be discussing two. So the first one we will be discussing is the capitalized cost method. So a capitalized cost is a cost that is incurred from the purchase of a fixed asset that is expected to directly produce an economic benefit beyond 1 year or a company's normal operating cycle. I got this definition from the corporatefinance.institute.com, so credits to them. And the capitalized cost formula we have here is equivalent to K, and K is equivalent to FC, or the first cost, plus M over I plus FC minus SV all over 1 plus I raised to N minus 1, where M are the maintenance cost, or the annual maintenance cost of the product or the service, and we also have plus FC minus SV, where FC is the first cost, SV is the salvage value, and then we have the N, which is the number of years. So that is said to be equivalent to K. And in order for us to get the annual cost, or the AC, that is just equivalent to K times I, or the capitalized cost multiplied by the interest. So these are the formula that we need to remember in solving for capitalized cost. So we have here an example of the capitalized cost. First is a telephone company purchased a microwave equipment for 6 million pesos with a salvage value of 600,000 pesos over a period of 5 years, and pay a lump sum of 400,000 pesos for the maintenance cost. Minimum attractive rate of return is 16% annually. First, we need to compute the annual maintenance cost of the equipment. Second is to compute the capitalized cost of the microwave equipment. And third is compute the annual cost of investment of purchasing the microwave equipment. So first is we need to identify the given values that we have. Again, we have FC that is equivalent to 6 million, and we have the salvage value, or our SB, that is equivalent to 600K, or 600,000, in a period of 5 years, so N is equal to 5. And we have here the lump sum of the maintenance cost is 400,000. So meaning to say M is equivalent to 400,000, or 400K. However, we have here the rate of return. I is equivalent to 0.16. That is 16% annually. So first, we need to find the annual maintenance cost. So here, the given here is the lump sum amount of the maintenance cost. However, we need to find the annual maintenance cost. So we need to use the annuity formula. So we have P is equivalent to A over I multiplied by 1 plus I raised to N minus 1 all over 1 plus I raised to N. So if you can remember, this is our ordinary annuity formula. So again, we already have the lump sum amount of 400,000. So we have here 400,000 is equivalent to a let's say that is annual maintenance. So let's just have that as A raised to M all over our I, which is 0.16, multiplied by 1 plus 0.16 raised to N, which is 5, minus 1 all over 1 plus 0.16 raised to 5. So if you try to calculate this one, annual maintenance cost is equivalent to 122,163.75 pesos. So this is now our annual maintenance cost. Now next is we need to compute the capitalized cost of the microwave equipment. So second, we have number 2. we need to compute the capitalized cost or the CC. So as we know, CC is equivalent to FC plus M over I plus C minus SV all over 1 plus I raised to n minus 1. So this is the formula of our CC or the capitalized cost. So we are looking for the capitalized cost of the microwave equipment. So again, the basis of this one is annually. So we have FC is equivalent to 6 million plus our annual maintenance cost, which is 122,163.75 all over our I, which is 0.16, and plus our FC minus SV. So we have here FC is 6 million minus our SV, which is 600K or 600,000 all over 1 plus 0.16 raised to n, which is 5 minus 1. So calculating this one, you'll get the result of 11,671,090.07 centavos. This is in peso. So this is now our capitalized cost. Next one is we have here compute the annual cost of investment of purchasing the microwave equipment. So annual cost, we are looking for the annual cost, and annual cost is given by the formula K times I. So let's just substitute the values here. So again, annual cost is just equivalent to K times I, where K is equivalent to CC. So we have 11,671,090 pesos 0.07 times our I, which is 0.16. So our annual cost is equivalent to 1,867,374.41 centavos. So this is now our AC or the annual cost. So that's it for this example. So another method under the economy studies is the rate of return method or the ROR. And rate of return is said to be a measure of the effectiveness of an investment of capital and its financial efficiency. When this method is used, it is necessary to decide whether the computed rate of return is sufficient to justify the investment. So we have the formula of our ROR, which is equivalent to the net annual profit divided by the capital invested. And the net annual profit is equivalent to annual revenue minus annual cost. So, meaning to say simply, ROR is equivalent to the AR or the annual revenue minus the AC or the annual cost and the capital invested or the C. So, the annual cost includes depreciation, labor, material cost, overhead, rental, tax, and insurance. So these are the inclusion, or we need to include this one for the annual cost. So we have here an example. An investment of 270,000 pesos can be made in a project that will produce a uniform annual revenue of 185,400 pesos for 5 years and having a salvage value of 10% of the investment. Out of the pocket costs for operation and maintenance will be 81,000 pesos per year. Taxes and insurance will be 4% of the first cost per year, and the company expects capital to earn not less than 25% before income taxes. Using ROR method or rate of return method, determine the rate of return of the investment. Is this a desirable investment? So we need to first identify the givens that we have. So the investment or the capital is equivalent to 270,000 pesos. And it will produce a uniform annual revenue. So we have annual revenue of 185,400. So our AR is equivalent to 185,400. And that is for 5 years. So our N is 5 years. Having a salvage value of 10% of the investment. So the investment is 270,000 pesos. So the salvage value is equivalent to 10% of 270K. So 10% of 270K is 27,000. And out of pocket cost for operation and maintenance, or OM, let's just put that as OM, operation and maintenance, is 81,000 per year. And the taxes and insurance, so let's just put as TI, that is 4% of the first cost. Or the first cost is our capital invested. So 4% of 270K is 10,800 pesos. So the company expects capital to earn not less than 25%. So our I is equivalent to 0.25. So we are looking for the rate of return of the investment. So in order for us to find the rate of return, we have the formula ROR is equivalent to AR minus AC all over C. We already have the AR, we already have the C, but we need to identify the annual cost that we have in starting up the investment. So for the AC, again, in annual cost, it includes the depreciation, the we also have the overhead, the labor and material cost, the rental, tax, and insurance. So we need to add all of them. So again, we have the AC is equivalent to the depreciation plus our OM, or the operation and maintenance, plus the taxes and insurances that we have here. So for the depreciation, the method, or the depreciation method that we'll be going to use is the sinking fund method, since it's the only depreciation method, the annual depreciation method that has an interest factor. So since we have an interest here, so we're going to use the sinking fund method. And the sinking fund method is equivalent to FC minus SV multiplied by our I all over 1 plus I raised to L, or N, minus 1. So that is added by our OM again plus our TI. So substituting the values, we have FC is 270,000, or that is the capital, or that is our capital investment, minus or subtracted by our salvage value, which is 27,000, multiplied by our interest, or 0.25, divided by 1 plus 0.25 raised to n, which is 5, minus 1, plus our operation and maintenance, we have the 81,000 pesos, plus the taxes and insurances, so we have 10,800. So basically we have the annual cost of 121,408.76 annually. So this is the annual cost that we have. So now, since we are looking for the ROR, we'll just substitute the values that we have here. So we have our AR, which is 185,400 pesos, minus our AC, which is 121,408.76, divided by the capital, which is 270,000 pesos. Now, if you calculate this one, this is equivalent to 0.237 And since we are looking for the rate of return, so multiply that with the 100%. So basically, our ROR is equivalent to 23.7%. But as you can see, it says here that the company is expecting the capital to earn not less than 25%. So we need to determine if the investment is a desirable investment. Since this one, as you can see, it is less than 25%, so meaning to say the investment is not a desirable investment. So another example we have here is a young mechanical engineer is considering establishing his own small company. An investment of 800,000 pesos will be required, which will be recovered in 15 years. It is estimated that sales will be 800,000 pesos per year and that the operating expenses will be as follows. Materials is 160,000 pesos per year. Labor is 280,000 pesos per year. Overhead is 40,000 plus 10% of the sales per year. Since the sales per year is 800,000 pesos, so 10% of that is 80,000 pesos. And the selling expense is 60,000 pesos. The man will give up his regular job paying 216,000 per year and devote full time to the operation of the business. This will result in decreasing labor cost by 40,000 pesos. So labor cost will decrease by 40,000 pesos. Material cost by 28,000. Materials will be reduced by 28,000 and the overhead cost by 32,000 pesos. So minus 32,000 pesos. If the man expects to earn at least 20% of his capital, should he invest? Compute the actual rate of return. So from here, we already identified the AC or the annual cost that we have. So this one. So the materials now deducted by 28,000 pesos will just be equivalent to 132,000 pesos. And the labor cost will now be deducted, will be reduced to 240,000 pesos. And the overhead cost will become 88,000 pesos since it is deducted by 32,000 pesos and the selling expense is still 60,000 pesos. So again, our FC or the capital is 800,000 and our AR or the annual revenue or the sales per year is 800,000 as well. And the capital is expected to be recovered by 15 years. So we have N is equal to 15. So for the AC, we just have to add up all this plus the salary of the man because he is giving up his job in order to give full time to his business. So meaning to say this will add up to the annual cost. So our AC now is equivalent to 132,000 plus 240,000 plus 88,000 plus 60,000 plus the salary of the person or the man plus again this will include the depreciation, so meaning to say we still need to find the depreciation of this one, and depreciation is equivalent to FC minus SB. So FC is 800k minus our SB, which is not stated, so that's 0, times the interest or 0.20, that divide that by 1 plus 0.20 raised to n, which is 15 minus 1. So basically, if you calculate this one, this is now equivalent to 747,105.70 pesos. So this is now our AC. But we are looking for the ROR, or the rate of return of the investment. So ROR is just equivalent to ROR is equivalent to AR, which is 800,000, minus our AC, which is 747,105.70, divided by the capital, which is 800,000. So calculating this, you'll get the result of 0.0661, and that is multiplied by 100%. So basically, our rate of return is equivalent to 6.60%. But again, the man is expecting to have at least 20%. But as you can see, the rate of return is very low. So meaning to say, this investment is not a good or desirable investment. So last example for the rate of return method is the ABC company is considering constructing a plant to manufacture a proposed new product. The land costs 15 million pesos. The building costs 30 million pesos. The equipment costs 12,500,000 pesos, and 5 million pesos working capital is required. At the end of 12 years, the land can be sold for 25 million pesos, the building for 12 million pesos, the equipment for 250,000 pesos, and all of the working capital recovered. The annual disbursements for labor, materials, and all other expenses are estimated to cost 23,750,000. If the company requires a minimum return of 25%, what should be the minimum annual sales for 12 years to justify the investment? So we are looking for the annual sales. So now we'll just identify the given values that we have. So again, we have the land. The land is said to be 15 million pesos. We also have the building. Let's write that as building. The building cost is equivalent to 30 million pesos. We also have the equipment cost, which is equivalent to 12,500,000. And we have the working cost or working capital, which is equivalent to 5 million pesos. So that is the working capital. At the end of 12 years, so our N is 12 years, the land can be sold for 25 million pesos. So meaning to say the salvage value of our land, this is not depreciating but it is appreciating. So the land after 12 years will become 25 million pesos. The building will be 12 million pesos. And the equipment can be sold for 250,000 pesos. And all of the working capital recovered. The annual disbursements for labor, materials, and all other expenses are estimated to cost 23. So another expenses is said to be equivalent to 23,750,000 pesos. And if the company requires a minimum return of 25%, so our I is 25% or 0.25, we need to find the annual cost again. So first that we need to do, we just need to identify first the depreciation for each of the following capital that we have. So we have for the land, again for the land we have the depreciation is 15 million minus the salvage value of 25 million multiplied by the interest, which is 0.25, divided by 1 plus 0.25 raised to n, which is 12 minus 1. So the depreciation for the land is said to be equivalent to 184. Sorry, I'll just erase this. So for the land, that is 184,475.77. And for the building, we have 30 million minus the salvage value of 12 million times 0.25 divided by 1 plus 0.25 raised to n, which is 12 minus 1. So our building, or the depreciation for the building, is 332,056.39 centavos. And for the equipment, we have 12.5 million minus 250K multiplied by 0.25 divide by 1 plus 0.25 raised to 12 minus 1. So the depreciation for the equipment now is equivalent to 225,982.82 centavos. So these are now the depreciation for each of the investment. So now we are looking for the annual revenue or the annual sales. So again, ROR is equivalent to AR minus AC all over C. Since again, as you can observe, that for the land, we did not depreciate, hence we have appreciate, or the value of the land um, increases after 12 years. So meaning to say AR, we need to add the appreciation or the increase of the value of the land by the with our AR, or the revenue of our investment. So we have 184,475.77 plus the annual revenue that we don't know, or we'll just put that as AS, minus our AC, in which our AC is this one. Our AC is 332,225, and this one. So the the annual cost that we have are the expenses, the equipment, and the building. So if you add the annual cost, we'll get equivalent to 24,308,039.21 centavos. That is divided by the capital that we have. So the capital that we have are the land, the building, the equipment, and the working capital. So we have 15 million plus 30 million plus 12.5 million plus the working capital, which is 5 million. So that is the capital that we need, or that we have. So ROR again is 0.25. So in order for us to get the AS, or the annual sales, we can just calculate this one, and that is equivalent now to 39,449,763.44. So the minimum, or the minimum annual sales, should be 39 million in order for us to to justify the investment after 12 years. So those are all the discussion under the rate of return and capitalized cost method. And I'll see you on the next videos for another method under the economy studies.